Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitri Programmatic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. I'm going to share my screen. Just a heads up, I still have that cold. I might be sneezing, and I apologize ahead of that. And I just took a cough drop. So hopefully, the voice.
The technical issue's been taken care of. Sorry about that.
Yeah. So anybody, if you're joining us for the first time today, Will and I, we do these shows in the morning to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on a show and ask your question live, we provide a link to Zoom. Click on that link. Takes you over to Zoom. Click on raise your hand. Once we let you in, you could ask your question live and direct. If you prefer to type your question in, you can do that in that live on a chat box on YouTube. Put it in there. Will's watching it. He'll read it back to me. While we're waiting for more people to join and for questions to come in, we'll start out taking a look at the pre-market report. And these are stocks trading in pre-market hours. See if we can get some insights. If we get some questions, well, let me know. We'll take those. If we don't get questions, I'll just navigate to one of the pages on our websites that we've been talking about recently. And we have been getting a lot of emails coming in after the last show when we talked about beta and regression analysis. So maybe we'll continue on that discussion. Okay.
Great.
So pre-market trading. These are stocks trading in pre-market hours. I'm going to come down here. We have a table with our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 57 stocks made our percentage gainers list, 37 on the decliners. So from this perspective, looks like we're setting up for a bullish bias at the open. But you can see here that we do have small cap stocks in there, ETFs, leverage products, closed-end funds, anything that's listed on the major U.S. exchange. If it's trading in pre-market hours, you could meet our and meets our thresholds. It could make this list. So let's narrow this list down to a smaller group of stocks. And to do that, we'll use the filters above here. I'm going to use this one in ETF. Click on that. You get a drop-down menu to choose from. The top three, those are the broad-based ETFs. The other ones are sector ETFs. Let's take a look at SPY. We'll click on there. The list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. Here we see 15 stocks made our percentage gainers list, 200 decliners. So from this perspective, it looks like we're setting up for bullish bias at the open. Still, we're getting a couple earnings coming in. That's what these E's are, letting us know their earnings. Looks like Cisco reported earnings down 4.4%. Couple things. I did get, some emails, interesting emails. People are using ChatGPT. I think, I'm sorry, I didn't even get to reply. I've been sick, so I haven't replied to many of them. I will today, but I know one of our users.
Yeah, I think Lauren's on today.
Lauren, yeah, he was mentioned he's using ChatGPT to do some financial analysis, so that's great. Even help them write some script that he uses. I think on TradingView, either TradingView or TradeStation, one of those.
It's TradeView.
Yeah, and you know what, you're starting, as you're using it, you're starting to see that a lot of things are going to change. And I think the CEO of Microsoft was getting interviewed, and they're asking, well, if people do use, these chat bots to do their search and for information, then they rely on the internet, the content creators, to allow these systems to basically crawl the web, get this content, and that's how it learns, right? So it does rely on the ability to go and crawl the web, and other content creators have to give it access. And what does the business model look like? How is it going forward? We have this search with display ads, and that's been around for a long time. Google's really good at it. Going forward, it's interesting to see, well, if the content creators are not getting traffic to their website, because they put out, why do they put out this content? Is they're hoping to get indexed, and then they get ranked higher on the search engines, and then you click on it and you end up going to their website. So they give you this content in hopes of either converting you to a longer term customer, or they make ad revenues from traffic. But if you're never getting to their website, if all the answers is right there in front of you, how does that model look like? Because content creators, could just block crawlers, right? They could say, I'm not letting you crawl and index my website, right? And then what happens? Then it all starts kind of not working. So it'll be interesting to see how that part develops, right? Because it does, this ChatGPT, it does rely on having this open, source of data and information on the web. So let's see. I mean, are there any questions yet, Will? If not, I'll just move on.
Nothing's popped up yet, and we actually have Sarush on YouTube today, which is nice.
Okay.
Typically been on the Zoom since he came over from the IBKR webinar. So, but no questions have popped up yet.
Okay, I'll come up to Microsoft. And I think some of the questions came up. We're looking at the beta, right? So we're looking at beta of stocks, and we did go through examples of, well, how's this beta calculated? Why is it different than other places? So you're not going to see the same beta maybe on our website as you will, like maybe on a different platform. That's because the beta itself, it's a derived, right? It's a derived value from a regression model, and the models, it depends on the data you're putting in there. And we kind of went over, examples of what to, how the data you're inputting can be different. And one of the critical, most important factors that goes into data analysis is data preparation, data cleaning, right? So your model, it'll create an output based on what you put in there, right? So it doesn't really, have the ability, to clean the data for you. That will be up to you. So it's only as good as the data that you're inputting in there. And data preparation, data cleaning is very important. That's one of the things that we try to concentrate a lot in the background, and sometimes you don't see it, but it's kind of giving it the relevant data. And I gave an example, like if we're trying to predict, right? If we're trying to predict the price of Microsoft, and this is getting back, I think, the user send an email about pairs trading, right? Can you trade pair, buy one stock, sell another that have a strong correlation? And when we try to predict the price of one stock, we'll call it, the dependent variable. This depends on a different variable, and we'll say SPY. So can we predict what will Microsoft price be relative to SPY price? And we're looking at percentage changes on a day. So we could run, we could just collect data for every day, right? We could collect data for every day like this. And we could see the percentage change in Microsoft. And then we could line that up with the daily percentage change of SPY. We run a regression model through it, and then it'll spit out a formula Y equals MX plus V. So this is a simple linear regression, right? And I'm going to come down here. So you get these numbers, you'll get the beta, you'll get the alpha, which we're not showing, the intercept, which we're not shown. So the beta is the slope, and then you get this R square. So the R square tells you the strength of the relationship. So if you have a 1, it means that they're perfectly correlated. You could have a -1, which also is perfectly correlated, just inversely. And then you get, if you get closer to 0, means there is no correlation. So those are things they, are going to be important for you to kind of understand the relationship, the correlation. And when we talk about, so getting back to the data that we're inputting, since we're trying to answer something, right? What are we trying to answer here? We're trying to say, based on what the market does, can we explain the price of Microsoft, right? So what we're saying is that, can we predict Microsoft movements based on what the market does? But when we look at the data, we go back in time, we may see instances where that does not apply in those instances, and we have to take those elements out of our model and not even use them. And I gave an example around earnings. So let's say Microsoft reported earnings, and people are digesting that information, and they're going to reprice Microsoft on those earnings. Well, in that situation, it's not appropriate to use SPY to try to predict what Microsoft will move on their earnings day, right? Because that's not why Microsoft is changing, right? So there are instances in your data that you got to take out and rerun your regression. Then when you rerun your regression, there are instances where you cannot use that regression. So for example, if Microsoft is coming out with earnings, I can't even apply it anymore, right? So that analysis, that model is not applicable. So you're going to have different models, okay, for different situations. So you can't, there's no one model fits all, and there's no one model that's going to be perfect and with exact precision. You're modeling, trying to get an estimated value based on some, related variable. Okay, so those are important things to understand. And I think I'll start going over models and model building more, but any model, you have to look at the data, prepare the data, reanalyze the data, there's a lot of analysis that goes on, even with a simple regression. You look at the residuals, you try to figure out what are these data points. Should I include them? Should I not include them? And even right now, as Microsoft is moving, so Microsoft is performing really well because of this chat GPT excitement. A lot of people are using it, and they're starting to price in, forward earnings based on their experiences with chat GPT. So even today's situation, right, even today's data, and even this model may not be applicable right? You may have to allow it to reprice around this firm specific news in Microsoft. All right. So, and it's when you have these tools available, you have these models available, you have these metrics available, but the models don't know if you're using it correctly. They just give you an output. And it's really up to you to determine, when to apply them, when to just think about like a good plumber or carpenter. They know what tool to apply and when and how. And that's really important, because I do see some people just, trying to take something, a metric or a model or something that they're seeing, and just kind of apply it across the board in general all the time. And doesn't work that way. So you could have many models, looking at different things, trying to explain it. And certain models are applicable at certain times. And I'll give you an example. In earnings, you're going to have a model that just focuses on earnings. And then once it's over, you can't apply that model, until the next earnings comes out. Then you're going to have models that are, applicable during other periods, but not on earnings, right? Maybe not when they have investor, maybe a different model when they have conference, some kind of conference, or they're attending something where they may reveal some new information about a pipeline or a product. You're going to have a different model for that too. You might have a different model when implied volatility is high or there's more uncertainty. You're going to have a different model when volatilities are low. And it's so it is important to understand that it's not like a one thing fits all. Like, I'm going to take this and just apply it across the board no matter what happens. It doesn't work that way. You have to know when things are applicable, when they're not, and they're just trying to assist you in your trading. Okay. So are there do people use linear regressions? I think there was the example like Pepsi versus Coke. Yeah, there are instances, that people will use that. They'll run a simple regression, say that there's nothing going on between these two companies right now that is fundamentally changing, or material information coming out there. And they could apply that model to try to price similar companies, that they stay, that they don't trade outside a certain range. So yeah,
we did have a question pop up
Yeah.
concerning modeling from Warren.
Yeah.
He says, for portfolio management, I multiply the SPY correlation with beta in order to get to a SPI weighted beta delta. Is this how Dimitri would proceed to delta beta weighing a portfolio?
I mean, I would have to see, I don't know if I could answer that question without really seeing all the details and factors going in there. Because I don't think I fully understand everything, that's surrounding. There's always these with finance. when we're dealing with financial assets and financial numbers and these different metrics, there's rarely can you give a general answer to everything. It's usually like, it depends, and I got to see the data and what's going on and what is the situation, right? But the situations could be changing and evolving, that all of a sudden now you got, these new exceptions in there, and how do you handle them? So I do get a lot of questions looking for a general answer, or an answer that kind of just applies, just kind of, this is the answer and you just apply it every time. But I can't give that answer, right? That's not how, if it was that easy, trading would be easy, right? But it's not. It's like, you have to go in there and analyze and understand that information and what's going on. So when you're talking about portfolio risk management, this is entire, it's science behind that, right? So you can't, there are trading operations, and they have teams just focusing on risk management, right? That entire teams, so that the traders themselves, or even, understanding the risk and putting on the risk originally, and putting on these portfolios, need another team to reanalyze their risk, and to make suggestions, or look at those parameters, and it's an ongoing analysis, right? So you don't have like a risk manager come in once a year, look at it, say this is what you do, see you next year. They're watching it continuously, and watching the different relationships, and how are these different variables and factors that are all interconnected changing, right?
And a lot of times they screw it up.
And a lot of times they get it wrong.
I mean, just look at all the banks that are in trouble have risk managers, right? Who are managing their risk.
They all have risk managers. They have to, right? They have to have it by regulation. They have risk managers signing off. Exactly. And this was a simple, seems like on paper, a simple input, right? Interest rate risk, duration risk. Yeah. It wasn't even that complicated, like the risk that they were taking, but they made assumptions, right? So that's the other thing with risk assessment, is a lot of it is based on your assumptions, right? There's a bias in it, right? You do have a bias in your risk assessment, and that's one of the reasons you should have an entire team focusing on risk management that doesn't have perhaps the same biases that the traders that initially put on that risk. Of course, you can't, as one person sitting there and looking at it, it's going to be up to you, and hopefully your risks are manageable and small enough, that it cannot, you shouldn't have it that it could blow you out, especially, when you're a retail trader trying to, manage your own portfolio. And we haven't done too much with risk management. We kind of focus on portfolio risk management. We kind of try to focus on the risk assessment prior to the trade, right? So pre-trade risk assessment, which is extremely important as well, because you want to make sure before you're getting in that you're understanding the risk. Because once you have it on, you have it on. So you have to be comfortable with it pre-trade.
All right. Well, Lawrence, if you want to explain it more and email it over to Mitri, I'm sure he'll take a look at it, and maybe we can talk about it tomorrow.
Yeah, I'll have to understand it more.
Rob was asking after that. He says, are the trading cards changed with earnings? I guess, how did the trading cards take in earnings?
So these trade ideas, if they detect that this expiration covers earnings, it will switch to a model that looks at earnings data. So it does switch to that. And let me see if I have a couple. I don't think I have enough time. I'll discuss this more maybe tomorrow. But when we create, theoretical values, similar to what we were talking about with a regression. So when you create a regression line, unless you have something perfectly correlated, one for one, a regression line is not something that's trying to predict something with exact precision, right? It's not something where the stock has to be at $314.01. That's not what it's doing. It's creating a line. Think of it as like where it's like an average, right, around the variability. So you're looking at, well, here's the best fit line, that fits right into between them, and then you have this variability around it, right? So you could have a standard error that's wide, you could have a standard error that's low. So it's really, think of it as, yes, it could create an output, with one price, but then there is this confidence interval around it. And it's really a range where it says that if you have a line with dots far away from it, then your confidence interval is going to be wide. You're good. That means it could be, the estimate, could be 314, but it could really be $1 around, between 313 and 315. 314 is just the midpoint of it. Or you could have one with low standard error, and your confidence interval, could be 313.95, 314.05. That plays into it as well. So when you have a big, when you think of it, when your observations, your residuals have a lot of volatility around that line, you have to take that into account, because even though you get this number, the real range could be very wide. Right. So when we're talking about models aren't there just to give you this precise value, right? It's really giving you this estimate, and the estimate itself can have a wide range. So
right.
I think we're right up at 9:30, Will.
Right up against a half hour in the opening bell. D. Great job as always, my friend.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Yeah, remember, thumbs up and subscribe to the YouTube channel if you're new. Thanks so much, D. Have a great ride today, Rob. Everyone have a great day. We will see you tomorrow.